You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit uraniumspotlight.com, featuring in-depth market briefings, sector analysis, and the free Uranium Investor Foundation series. Essential reading for understanding today's nuclear fuel landscape. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's February 17th, 2026, and this week on Uranium Spotlight, spot prices rebound on fresh financial demand. China tightens its grip on Namibia supply via Bannerman. Niger abruptly reverses course on Orano's uranium. India's Adani moves into nuclear, and Cameco and Paladin show what producer fundamentals look like in a tightening market. The uranium spot price opened last week at $85.70 a pound, U3O8, and closed at $89.75, a clear rebound in a week where the usual published market commentary was limited due to the U.S. holiday. Even without a formal weekly summary, the price action told a familiar story. Modest incremental buying can still move the market when the available float is thin and sellers are selective. The clearest catalyst was financial demand. Yellowcake announced a new share placing tied directly to exercising its 2026 Kazatomprom option. The company disclosed an offered purchase price of $86.15 a pound for approximately 1.16 million pounds, framed as a discount to prevailing spot indications, with funding due by February 25th. That is a direct example of capital markets translating into physical buying, and it matters because it represents incremental demand that does not depend on utility tender timing. Zooming out, the broader setup remains constructive. Producer guidance cuts last year reduced near-term supply visibility. Utilities have increasingly extended contract tenors to 7 to 10 years. Origin assurance clauses are being standard in tenders, effectively shrinking the pool of acceptable pounds. And Japan's first physical uranium shipment in roughly 11 years has converted restart policy into actual fuel movement. This is a market that continues to move in steps rather than a straight line. Producers remain disciplined. Utilities remain focused on security of supply. And the marginal buyer increasingly includes well-funded financial vehicles that can act quickly when windows open. For investors, the key takeaway is that the spot remains highly sensitive to marginal buying. When financial vehicles are funded and active, price can firm quickly even without heavy headline news. Bannerman Energy has advised the public of its binding investment subscription and joint venture documentation with China National Nuclear Corporation. CNNC will now control a 45% stake in Bannerman, and through that, an underlying 42.75% stake in Bannerman's forthcoming Etango mine, of which Bannerman nominally owns 95%. The remaining 5% is owned by Namibian social welfare organization called the One Economy Foundation. CNNC will control this large share of Bannerman and Etango through its subsidiary CNNC Overseas Limited, itself a subsidiary of China National Uranium Corporation. With this investment and with CNNC already owning the Rosing uranium mine in Namibia, China now appears positioned to influence a substantial portion of Namibia's present and future uranium production. Another majority Western-owned mine in the area is Paladin's Langer Heinrich, although CNNC also owns 25% of that operation. Russia has also expressed interest in Namibia's uranium wealth through civil nuclear cooperation agreements. Taken together, Russia and China already control a majority of global uranium production through their influence in Kazakhstan, Uzbekistan, Russia, and China, and now through growing exposure in Namibia. Etango is expected to produce approximately 3.5 million pounds of U3O8 annually, with reserves of 207 million pounds. There's also potential to expand production to 6.7 million pounds a year. Work at the mine is progressing ahead of final investment decision, including bulk earthworks and heap leach drainage construction. Without significant new Western investment in greenfield production, the coming supply crunch may be longer and more complex, particularly for Western utilities that still account for a large share of global nuclear generation. For investors, this matters because strategic buyers are not simply acquiring pounds. They're acquiring long-duration control over future supply optionality, which has clear geopolitical and pricing implications. If you want to understand the structural mechanics behind this, the full analysis is found in our Uranium Spotlight briefings at uraniumspotlight.com. Niger has elected to return 209 million pounds of U3O8 to Orano and France following the seizure of mines in the fall of 2024. The original seizure followed a Russian-backed coup in 2023 that brought a military junta to power. Niger had initially explored selling some of the uranium to Russia and began transporting material toward that objective. Land routes to the seaport of Togo proved unsafe due to insurgent activity, and an air route was subsequently used to move uranium to an air base adjacent to the international airport. This was done despite pronouncements from an international court of arbitration. 2 weeks ago, the airport was attacked by armed gunmen on motorbikes with drone support. The attack was repulsed, with heavy losses among the attackers. Now Niger is returning uranium stockpiles to Orano at the original ownership proportion of 63% from the Somer mine. Whether this signals a broader geopolitical recalibration or reflects behind-the-scenes negotiations remains unclear. What is clear is that production in Niger, more broadly in parts of Western Africa, have been materially set back by political instability. For investors, this matters because ownership of inventory is not the same as reliable production. Recovering pounds is helpful, but geopolitical risk can permanently impair timelines, financing, and confidence in future supply. Indian utility Adani Power has spun off a new subsidiary focused on nuclear power. The Adani Group is a Fortune 500 company and one of the single largest corporations in India. Adani Power is already the largest private thermal power producer in the country, although the sector remains largely state-dominated. The resources and execution capability that Adani can bring to nuclear are significant. The group has experience navigating regulatory processes and securing grid connections, both of which are critical for large-scale infrastructure projects. It also has experience in non-fossil fuel energy through its renewable developments. This development follows passage of the Shanti Bill, which reformed India's nuclear power sector to allow private sector participation and align nuclear liability laws with international standards. The legislation was passed to support India's goal of reaching 100 gigawatts of nuclear capacity by 2047. Without these reforms, India's primary nuclear operator, Nuclear Power Corporation of India Limited, would have remained largely on its own in driving expansion. Now, major infrastructure players such as Adani Group, Tata Group, Hindal Renewables, Larsen & Toubro, and NTPC are either expressing interest or entering into joint ventures to build reactors. For investors, this matters because India represents one of the few large-scale demand growth stories capable of shifting the global balance over the next decade. Private capital participation is what converts long-term ambition into contracting activity and ultimately uranium consumption. Last week provided a clear reminder of how improving uranium fundamentals begin to surface in reported financial results. Cameco reported full-year 2025 results, highlighting disciplined supply behavior and a contracting environment increasingly focused on security of supply. The company noted approximately 230 million pounds committed under long-term contracts and emphasized tightening secondary supplies and longer-than-expected development timelines for new production. Financially, Cameco reported 2025 revenue of $3.482 billion, net earnings attributable to equity holders of $590 million, adjusted EBITDA of $1.929 billion, and cash provided by operations of $1.408 billion. Paladin reported its December 2025 half-year financial results with revenue of $138.3 million from sales of 1.96 million pounds at an average realized price of $70.50 a pound. The company reported gross profit of $26 million and noted that results were still influenced by the ramp-up at Langer Heinrich. It also highlighted a strengthened balance sheet, with total unrestricted cash and investments of $278.4 million following equity raising and debt restructuring. For investors, the key takeaway is this. Disciplined producers operating in a tightening market are beginning to demonstrate operating leverage in real financial terms. Dependable pounds, long-term contracts, and improving realized prices are the combination that ultimately drives sustained cash flow and equity re-rating potential.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit uraniumspotlight.com. Join us again next Tuesday for another edition of Uranium Spotlight.